Let's talk about something that can be, well, one of the most frustrating things to happen at tax time. You file your return, you're waiting, and then, boom, a rejection. Or maybe a really confusing letter from the IRS shows up a few weeks later. If you're a divorced parent, or maybe you have a young adult on your health plan, the culprit is often this one, single, really misunderstood form, Form 8962. It's supposed to be about a tax credit, but it ends up creating a huge headache for families with shared health policies. We're going to clear that all up right now.
So you did it. You spent all that time getting everything just right, you hit e-file, and you're waiting for that sweet confirmation email. But instead, you get a rejection. Ugh, it's so frustrating. But believe me, you are not alone. This is one of the most common hiccups when e-filing, and it almost always points back to one specific issue. If you see this code, F8962-070, that's basically the IRS computer system raising a red flag. It's telling you, hey, my records show someone in this family was on a marketplace health plan, but I don't see the form to account for it. The whole system is basically paused, just waiting for you to file Form 8962 so it can connect the dots. Okay, so maybe your return was accepted and you thought you were in the clear, but then weeks later, instead of a refund, an official-looking envelope from the IRS shows up. Your heart sinks a little, right? You open it up and it looks all official and kind of intimidating. This is the other really common way this whole issue comes up, and again, it's usually not as scary as it looks. That letter is most likely what's called a 12C. Now, take a deep breath. This is not an audit. It's not a penalty. It's simply a missing information letter. The IRS has just paused your return, and they're asking you to send them the documents they need to finish processing it. And you guessed it, that means Form 8962 and the form that helps you fill it out, Form 1095A.
So why all the fuss? I mean, why is this one form causing so much trouble? Well, both the rejection and that letter boil down to one thing: the premium tax credit. The IRS just needs to make sure all the numbers are accounted for correctly when a health insurance subsidy is involved. Let's really quickly break down what this credit actually is. The premium tax credit, or PTC, is pretty straightforward. It's a government subsidy, and it's designed to make health insurance that you buy from the marketplace, like healthcare.gov, more affordable for people based on their income and their household size. Simple enough. But here's the key part, the part that causes all the confusion. Most people don't wait until tax time to get this money. They get it paid in advance every single month, sent directly to their insurance company to lower their bill. That's the APTC. The catch? It's all based on your estimated income for the year. And, estimates can be wrong. And that is the whole point of this entire exercise. At tax time, you have to reconcile. You have to compare the advance payments you got based on your estimate with the actual credit you really qualify for based on your actual income. Form 8962 is just the worksheet the IRS gives you to do that final math.
And where do you get the numbers for this magical Form 8962? From this document right here, Form 1095A. The marketplace sends this out to you, and it lists exactly who was covered, what the total monthly premium was, and how much was paid in those advanced credits each month. This form is your source of truth. Okay, so if it's just a simple reconciliation, why all the rejections and letters? Well, the problem comes from a fundamental data mismatch. It happens when the people listed on that one insurance policy don't all end up on the same tax return. This right here is the root of the whole conflict. The IRS computers are trying to match two different groups of people. On one hand, you have the coverage family. That's everyone listed on the 1095A. On the other hand, you have the tax family. That's the person filing the return and whoever they claim is a dependent. When these two lists don't match up perfectly, the automated system just gets confused. And this happens all the time in really common situations. The classic example is divorced parents. One parent pays for the insurance policy, but the other parent is the one who claims the child as a dependent on their taxes. Or think about a 22-year-old who's still on their parent's plan, but files their own tax return. Suddenly, one policy has to be accounted for across two completely separate tax returns. So how in the world do we fix this? The answer is a specific strategy called the shared policy allocation. You're basically going to use the tax form to give the IRS clear instructions on how to split up the financial information from that one 1095A between the two different tax returns. All right, step one. Let's talk about the parent who enrolled everyone in the policy, but is not claiming the dependent on their taxes. We'll call them the 0% allocator. On their return, they need to fill out Part 4 of Form 8962. They'll put in the other parent's social security number and then enter zeros in the allocation boxes. This is a crystal clear signal to the IRS that says, hey, I'm connected to this policy, but 100% of the financial stuff is being handled on someone else's return. Now, for the other person, the one who is claiming the child and therefore taking responsibility for the tax credit, they're the 100% allocator. They also fill out Part 4. They'll enter the enrolling parent Social Security number and put 1.00 for 100% in those allocation boxes. This tells the IRS, I'm taking full financial responsibility for this policy on my return. Then they just use the numbers from the 9095A to complete the rest of the form like normal. This table shows you exactly how these two returns connect with each other inside the IRS system. See how each parent cross-references the other's Social Security number? One allocates 0% and the other takes 100%. So when the IRS computers process both returns, they see the cross-reference, they see that the numbers add up to 100%, and poof, the mismatch is resolved. The system can now move forward. So what happens if you already filed and you've got that letter 12C sitting on your desk? Well, the good news is you now know exactly what you need to do. And the process is all about responding to the letter, not starting your entire tax return over from scratch. Here's your checklist. And the most important point, I cannot stress this enough, is right there at the top. Do not file an amended return, a 1040X. A 12C letter is just a request for more info, not a demand to amend. All you have to do is fill out a new, correct Form 8962 showing that 0%, 100% allocation, attach a copy of your 1095A, and mail or fax it to the address they give you in the letter. That's it. You're done. At the end of the day, this entire process really hinges on one thing that no IRS form can fix: communication. For this to work smoothly, both parties, whether we're talking about ex-spouses or a parent and their child, have to cooperate. You have to agree on who's taking 0% and who's taking 100%. You have to share the 1095A form, and you have to correctly use each other's Social Security numbers. In the end, it's really less of a tax puzzle and more of a teamwork challenge. The key isn't just knowing how to fill out the form, it's coordinating with the other person to make sure you both get it right.